Hey, welcome back everybody to another video by Fully Informed Trade, or Fitrade for short. Alright, so let's go ahead and get into the chart action. Right now, the US dollar index has been able to find some support on that 20-day and 50-day moving average, and basically we've been able to find somewhat of a support, and if in the event we do find support and continue higher, this could cause equities to continue to fall. Of course, moving back to the Euro-US dollar, Euro-US dollar did have a pretty significant bounce. That was because of Euro repatriation, according to some reports that I've read. But overall, the way I think of it is that the algorithms are right most of the time. Remember, stronger dollar is typically indicative of weaker equity markets. Euro being sold off is primarily due to the fact that, again, we anticipate rate hikes to continue to go up in the future. Remember, markets trade on the 2-year expectation time frame. So even if you have a short-term bounce because of repatriation for banks to shore up their balance sheet in the European zone, there is still the likelihood that the interest rate structure will continue to fall in the ECB. And remember, the Federal Reserve has a 0.25% to 0% prime rate, whereas the ECB central bank has a 1% prime rate. If in the event the prime rate does drop, which it most likely will, down to 0.75% by the end of this year, and even down to 0.5% in 2013, chances are we should anticipate the Euro-US dollar to continue this longer-term downward trend. However, over the short term, whenever equities do have a significant pullback, the Euro-US dollar likes to pull back as well. Many people think that perhaps the repatriation might have an effect, but I think it's a modest effect at most because banks don't represent a vast majority of the currency exchange. There are other factors to consider as well, such as risk mentality. If you own Spanish bonds, would you honestly repatriate your currency back into the euro and anticipate over the longer term trend the euro to continue to depreciate against a broad basket of currencies throughout this whole entire time period, rather than investing your euros outside of Europe? And you would at least protect your losses, and you wouldn't be as exposed to the banking crisis. So some of it would be in repatriation, and I still think a lot of people will continue to invest outside of the European economic zone just to hedge their losses. Another thing I do want to mention is that the Spanish borrowing costs surged in the debt auction today. Spain has sold 3.2 billion euros of 12 and 18-month bills with 12-month price to yield 2.62% versus 1.4% 1 month ago. So yields did rise substantially, and that's the main reason why the euro is pulling back. Main reason being a lot of diversification outside of the euro because, again, Spanish bonds are depreciating, and when they depreciate, people like to sell their bonds and they like to buy into less risk, or I guess safer assets or more quality assets such as the U.S. Treasury bond. Okay. Now the European-Japanese yen has had a pretty significant bounce on the session. Again, the Euro-Japanese yen and the Euro-US dollar did have a decent bounce. Again, a lot of people are speculating on repatriation, and again, that bounce is what's making the U.S. dollar index not able to decline, which makes it seem like, at least, that the Dow Jones Industrial Average should be able to continue higher just because the dollar index has been able to decline. At least that's the whole entire idea here. See 2 days of consecutive declines on the dollar index, and the Dow Jones Industrial Average does have a pretty significant bounce on the session. Now that being said, the Dow Jones Industrial Average has been able to gain 1% on the day session, even after some horrific losses on the Apple trade yesterday with a huge surge in buying. Right now the volume is extremely light on the Dow component, as you guys can see, down in the 100 millions, and we are getting a slow stochastic reversal right here. But for right now, I would remain a little bit cautious. Again, markets don't always fall immediately. There's usually a downtrending motion, and we will find out whether or not this is a confirmation of a downtrend, or if in the event the markets do want to pursue this market higher, we would be able to tell just because the market has been able to break the 20 and 50-day moving average for a single session all at once. It was a huge move, and again, it was a bullish engulfing pattern of the past 5 sessions, and we're back at around the 13,100 area. One thing that I do have to note, though, is that 20-day moving average right here is kind of containing the market along with the 50-day moving average. If we do get a pullback tomorrow, which we could, or most likely will, chances are that pullback will result in a huge spike in volume. If that volume spikes, chances are you're going to see a pretty significant pullback on the Dow component, but it really depends on whether or not we can break that 20 and 50-day moving average in the following session. If not, we pull back and we give back a lot of these gains that bulls have been able to pull off since the 2,700 area, 12,700. Okay, now moving on, let's talk about the gold market. Gold market has been able to basically consolidate for quite a while. There's not much of a real pattern here, except for the fact that we do have some support down in this area, right around the 1,620 area. And since the US dollar index has been declining a bit, we have seen a bit of a bounce in the gold market, but not by much. Investors are trying to gauge how to really trade this market, because we have two conflicting theories here. A strong dollar trade would imply that gold and assets should decline, but the problem with that is that the dollar index is kind of paired to a bunch of currency pairs, and the currency pair that is primarily paired to is the euro, and the euro is basically fluctuating a lot. And what I mean by that is, whenever people flee into the euro, the value of the euro tends to skyrocket, and when the value of the euro skyrockets, what happens is that the US dollar index tends to decline. And that's not what you would really anticipate in the market, where people are scared, there's this risky mentality or risk-off mentality, and all of a sudden the dollar rallies, and is that really a signal to be buying, or is that really a signal to be selling? And people get lost in all the noise and all the information that gets out there. But one thing is for certain, though, is that the dollar index has been on a consistent uptrend for quite a while now. Ever since October, since 2012, we did see a pretty weak dollar for the past 4 or 5 months. But over the past, whenever the dollar did have strength, it was always through a European crisis, and every single time there was a European crisis, granted, there was always this euro repatriation every single time. So if I were to put my bet, honestly, I still think a strong dollar would mean a weaker market, and a weaker dollar would still mean a weaker dollar would mean a stronger market, a strong dollar would mean a weaker market. I'll still stick with that. Some people might think I'm crazy, but I think that repatriation is really just a short-term event, and that if in the event the dollar continues to trend higher, if it does, if not, oh well, but if it does, chances are you're going to see a pretty significant move to the downside in the markets. Now, I want to go ahead and talk about the silver chart. Silver is kind of consolidating, and again, I think traders are having a hard time gauging whether or not to buy or sell these markets. But honestly, I don't really have much of an idea what to say about silver right now at this point, except for the fact that it is trading in a wedge pattern, and whatever direction it is able to break out of, chances are that's where silver is going to trade. Right now, it is having some short-term resistance at around the 32 area. If it's able to break above that, chances are it's going to get to 32.20. But again, main reason why silver has had a pretty decent day on the session is because, again, the US dollar index has had a decline. So again, the inverse correlation still plays out with both equities and the dollar. However, the dollar is finding some support on that 20-day and 50-day moving average, and that repatriation was a relatively short-term trade. Therefore, I still anticipate the dollar index to eventually continue this pullback, or either not really anticipate a pullback, but to bounce off this level, because the euro is going to pull back eventually, the dollar is going to strengthen off that, and chances are the silver market will weaken, and this will most likely be a temporary bounce in the market. Also, I do want to mention the volatility index in my chart. And basically, the volatility index has had a pretty decent bounce. It is trying to hold on to that 20-day moving average. And if you guys notice here, there is a bullish flag formation going on right now. And it wouldn't be surprising to see a huge breakout on the volatility index. So watch the markets very closely tomorrow, because there could be a very significant move in the opposite direction than what you are honestly anticipating. Another thing I do want to talk about is the Apple chart. Apple has had a pretty significant day on the session. Again, Apple has been able to regain some of its gains. And basically, it kind of leveled out to where it started out the previous day. As you guys can go ahead and see, we started out right here yesterday, and basically the market's traded it back up to its previous level. However, I do want to mention something here, is that even though Apple has been able to trade back to its previous level, the volume still remains high. So what this could be is just a short covering rally, and that it doesn't necessarily mean that the market has necessarily stopped being volatile. Remember, volatility can go either direction, whether it's short covering or rapid selling. At this point in time, though, because the volume remains high in both a short covering and a rapid sell-off environment, chances are I wouldn't purchase a stock, regardless of the strong fundamentals, regardless of the strong forecasts, mainly because of the fact that Apple is already a $400–500 billion equity. Many people are forecasting the stock to at least trade into the $1,000 to $900–800 range by the end of the year. However, or end of the fiscal year for Apple, which would be around September. But problem being is that if Apple does trade to that $1 trillion valuation, where does the money come from to buy up the equity in Apple? Because again, there's only $12 trillion in broad money, in terms of broad money, broad stock money, or whatever you want to call it. But we only have $12 trillion here in the United States, and not everybody's going to spend, or not 10% of the money that's spent in the United States that goes towards investing is necessarily going to go towards bidding up Apple stock. So the issue here is scalability. How much can people buy up the stock so that it meets its intrinsic valuation, and can Apple continue to outperform? Those are two questions I want to point out, but since Apple has had such a consistent history of being able to outperform, beat expectations, continue to grow earnings at a very rapid rate, regardless of how large of a company they've become, chances are we couldn't really bet on a sell-off happening because of Apple's performance tanking. But what we could anticipate is that the market isn't able to, I guess, bid up the value of the stock because there's not enough money to go around to buy Apple's equity alone. Because again, Apple is a huge company, and trying to bid up a company that's worth 5% of all the money that's inside the United States could be a little difficult. So again, I am still a skeptic. I'm bearish on the stock, and this stock could continue to head lower. I do anticipate some support at around this area right here, which is where I found support off of. This area right here, which is the 560 area and the 50-day moving average, but eventually I anticipate it to reach back down into that 200-day moving average, because stocks always get back to their 200-day moving average at some point in the future. Take care, folks, and I hope you guys have a wonderful trading session.